According to Reuters, hedge funds have gone on a massive redistribution of assets. What are they doing? According to Reuters, they are dumping everything in their portfolios except real estate. Now, when I read articles like this, I think of a couple of things. One, if Reuters has picked up on this trend, it is already over. That's the first thing I think, right? How does Reuters pick up something that hedge funds are doing? It's obviously late and it's already been executed. And frankly, number two, hedge funds could already change their opinion. Hedge funds move very quickly and they look for alpha and all of that. But second, I asked myself, why would someone do that? Right. And again, according to Reuters, their source was Goldman Sachs. So again, you can just look up Reuters and go find this article for yourself. But really what it is saying is hedge funds see a couple of dangers in the future. The biggest danger is inflation. What they are seeing is a combination of things that could potentially reignite inflation, which would be no bueno, would be not good. However, what they also see is, frankly, inflation's a feature, not a bug. If you happen to own hard assets, and if those hard assets actually produce cash flow, aka yield, you come out on the other side smelling like a rose. So it was really interesting to read this article. It was actually a pretty short piece, only 3 or 4 minutes long to read it. But it was interesting to see the chess pieces moving with expectation of inflation getting worse from here or reigniting. So thought that was interesting. Thought we should talk about it. A couple of other things that caught my attention. I need to let you know about an interview that posts today at 4 p.m. If you are a One Rental at a Time fan, I would set your alarm for 4 p.m. Pacific because there is an interview that I never, ever, ever thought I would do. It's with an individual that I've spoken about on this channel that, frankly, I have not had very good things to say. And we sat down thanks to some mutual friends, and we had a conversation. And I think you will enjoy it. And I will say that my opinion is you'll see in the video. So set your alarm 4 o'clock. It's an interview that I never ever thought would happen. Frankly, wasn't looking for, didn't want, and it turned out to be, frankly, a lot of fun. So look forward to your feedback and thoughts on that. We did get some more words from the Fed. Again, that was what this week was. I think there was something like 12 or 13 Fed press conferences or presentations. We got Goolsbee and Jefferson. Anybody else? Nope, those are the only two. So let's talk about Jefferson, Vice Chair Jefferson. Long economic expansions aid in reducing inequality. I read that. I kind of dug in and thought about it for a while. And what is he really saying there? Basically, long expansions raise all ships, which is interesting because I think if you look at the last 3 or 4 years, that hasn't happened. The divide between the rich and the poor seemingly, and I don't think you can argue it, has gotten worse. But again, when you think about what we're doing here, we're talking about wealth and all of that, it really comes down to owning assets, right? That is the thing. Owning assets, preferably assets that cash flow, assets that you can hold for the long term. And if you hold them for a decade, it's kind of a no-lose situation. So again, it's interesting to think about that. So again, a long economic expansion would allow more and more folks to secure assets. And by doing that, more people win. Fed President Goolsbee out talking again, saying the U.S. economy is strong and we plausibly have full employment. You know, I think that is a reasonable statement. I don't know if you guys know this, but when I was going to school and getting my econ degree, full employment was thought to be 6%. Sometime in the early 2000s, that was adjusted to 5% was where full employment lived. And if you don't recall, we are currently sitting at 4.1. We will get a new unemployment number tomorrow. Expectations are we stay flat at 4.1. So again, I think Goolsby, I think he's right. Number 2, believe and agree with the sentiment on no rush on adjusting policies. Folks, we are getting more and more Fed presidents to basically take March rate cuts off the table. Again, I think that will be a theme all year. But yes, I think the Fed presidents are currently actively trying to talk down the odds of a March rate cut. And then finally, Goolsby, rates are still restrictive, even with 100 basis points in cuts. I think this is actually interesting, and we'll talk more about this in a minute. We'll actually move on to Scott Bessent in a minute. And I think what's really going on today is not so much the Fed rate, which again has been cut 100 basis points. It's the fact that the 10-year note is up roughly 80 to 90 basis points. That is what is restrictive. That is what is slowing housing. That is what is slowing refinances. That is what's slowing business acquisitions. That's the thing. So what did we hear from Scott Bessent, the new Treasury Secretary? What is Scott and Trump focused on, President Trump focused on? They are not focused on the Fed, which I think is a good thing. They are focused on the 10-year note. And if you've watched my channel for the last couple of weeks, that's where they should be focused. We've talked about it. There are things that they are actively doing to bend the curve, to remove the term premium, to lower rates. They are focused on deregulations, tax cuts, oil. I keep telling you, oil's the like first domino. Deficit reduction. If they can focus and get all 4 of those moving in the right direction, the term premium will come down. And frankly, rates could collapse. The question is, will it be 25 or will it be 26? A lot of people see these things and think they happen quickly, to which I remind you, that's not how it works. We've got to see it. The market's got to believe it. But frankly, we should all hope that they are successful and that we could keep this thing going. One thing we talked about yesterday in the daily financial news, given the violent move in rates down on the 10-year yesterday, that I forecast, guessed, predicted that the 30-year mortgage rate would drop below 7%, and it did. According to Lance Lambert at Resi Club, the 30-year mortgage came in yesterday at exactly 6.99. The first day of 2025 where the mortgage rate is below 7%. The 10-year note is up slightly this morning, so we might nudge up to 7%. But tomorrow is a big day. Tomorrow is the 3rd and final jobs number of January, and we will see where rates go from there. We did get an update on weekly unemployment claims, which we get every Thursday. Expectations were for 213. Last week was 208. These are all in hundreds of thousands, so 213,000 was the forecast. Last week was 208,000. Actuals, 219,000. Again, we are bouncing around the low 200s, nothing to be concerned about. We will be concerned if it makes a big break over 250 and get really concerned over 300. We are not there yet. But for the doomers, we will see if we get there next week. Again, the thing that I am asking you to focus on is continuing claims. My fear, again, for 2025 is the unemployment rate will stay low. I don't know, call it 4 or 5 or lower. But duration will expand. And how does that show up in the numbers? Continuous claims. Continuous claims did go up to 1.89 million. If I am right, in 2025 is about longer duration unemployment. We could see continuing claims go to 2.5, 2.8, and dare I say, possibly 3 million. That's what we will be looking at each and every week. Want to talk about the real estate market. Yesterday, Beth Traverso knocked my socks off at 4 o'clock talking about bidding wars coming back. And quite a few of you replied to that video saying, yeah, we're seeing that as well. It got me thinking. I spent a lot of time thinking about this morning. What is actually happening in most real estate markets? I think if you step back and you look at your buy box, I see 3 very different things. Number 1, turnkey versus junk. What do I mean by that? Turnkey you could think of as move-in condition, full flip, nothing to do, all of that. That stuff is moving in most of the country faster than junk. Junk, again, historically, in the last 2 years, moved quickly because the good stuff never showed up. Or if it was gone in a moment. So the junk was still selling. What we are seeing today is junk is not selling. What does that really mean? I think it means the buyers are stretched. Buyers are they're crying uncle. What does that mean? Well, they're willing to take on 7% mortgages, but they don't want to do a remodel. They don't want to drop $8,000 on an AC or heating unit. They don't want to replace a $20,000 roof. They don't want to, replace a deck. It's got to be move-in. They got to put it all on the debt because, again, they're going to do probably a bigger down payment than they normally would to get the payment down. And they just don't have, or frankly, don't want to dip into their savings to do anything extra. So that is something I think most of the country is seeing. Next, I still believe we have a bifurcated market. I still think we have median and below and median above, specifically 2x the median in any market. If your market's 300, anything over 600. If your median is $1 million, anything over 2 million. I still think we are seeing a market where luxury, again, 2x the median, is stacking up and days on market are growing. And what we're seeing is below the median move faster, orders of magnitude faster. Days on market for below the median, most of the country, probably less than 20 days. Luxury, days on market, probably approaching 90. And it's this differentiation that real estate analysts, doomers, don't understand. They try to take a growing inventory of luxury with days on markets of 90 and above, and they try to tell you that that is the market. I'm here to tell you that's never been the market, and it is extremely not the market today because, again, we have a bifurcated market below and above the median. And then finally, new versus existing. This has certainly been true, I think, for the last 12 to 18 months. We're likely going to see this continue for the next 6 to 9, possibly even 12 months. New construction is going to be moving faster than existing. Why? Very simple. Builders have this tool called profit margin where they can use it as a weapon. They can eat margin, buy down rates, give credits, do whatever the heck they want to do to get a payment at a point where it helps a buyer say yes. So, what are you to do? If you are a real estate investor, what are you to do? Well, I think it is very, very simple. First, nothing has changed. You need to get a buy box. You need to look at it every day. You need to learn average. If you don't know how to do any of that stuff, I do have a $50 course on buy box that you can get on my website. It's $50. It tells you what I've done, what I'm still doing. You need a buy box. You need to look at it every day. You need to figure out what average is. And once you find average, you are set to go because we don't do average. Any idiot can do an average deal. That's not what we do. We only want to do great deals. So you want to do something that's 3% better yield. And if you don't know what I'm talking about, buy the $50 course and you'll figure it out. But here's the deal. What you should be looking for is non-turnkey units below the median existing home sales. That is where you can write disrespectful offers. And I want to remind you that we had an example from our school community, Heath. There was a property listed at 200, picked up for 145. It can happen. You must believe. You must trust the process. It's not easy. It takes follow-up. I don't want to, it works. If you work the process and you do it, you can win. We are seeing a couple of earnings. What do we got? We got Tapestry, aka Coach. They had strong holiday sales and raised guidance. Yes, we are still shopping. Ford beat top line, bottom line, but indicated that profit is at risk because of tariffs. Given the estimates, it's possible that there might be upwards of $2,000 to $3,000 in extra cost should tariffs go into effect. Yum Brands, basically Taco Bell is crushing it. Taco Bell fuels the earnings beat, and they also raised their quarterly dividend. I do want to talk about rent by the room. This is something that I think is a solve for the affordability problem. We have lots of folks in our school community joining that are executing this process. The interview that I have at 4 o'clock today brings up rent by room as a solve for the affordability issue. I want to ask a question of the folks that are doing it or thinking about it. I am thinking about putting on a free 3, 4, 5 hour session where I go and collect people actually doing it. Maybe we reach out to Pad Split, I don't know. And we just dig in. Right? I understand, you understand at a high level rent by the room, but I don't think we really know. Again, one of the solves for the problem we have today might be or is, depending on where you are located, rent by room. Think of them as micro apartments. And I want to dig in. It's not something I've ever done. It's frankly something that I probably won't do. But again, I'm at a different stage. I'm good. But might be something I would do if I was starting. So I am thinking about doing that. It came to me this morning that I should really dig in because I want to learn. I want to ask questions. And I want to help people see what's possible. So I am thinking about doing it will be virtual. Take strike probably. It will be virtual. That way more people can attend. Let me know if you have interest in that. Again, I could bring on 3, 4, 5 different folks, get different stories, and might be fun. Might be fun to do. So let me know if you have any interest in that. We also got earnings from Peloton. They actually beat holiday sales expectations, right? Peloton was one of those pandemic darlings that got wrecked. They're starting to put the pieces together, it appears. And then Roblox, hopefully I'm saying that right, gave a very weak forecast and actually had a fall in daily active users, which is not helpful. Lastly, we'll talk about accountability group. Again, folks, we have 6 different masterminds and accountability groups inside the school community that you could join and be a part of. Again, find the one that meets your needs. No need to join all 6. I'm not saying that. I would not join all 6. You'd be on the phone all the time or on Zoom. But find the one that fits your schedule, that fits your tribe. Yesterday was Frank's 32nd accountability group. Frank, old guy REI's 32nd, 3 hours. Talked about exit options for fire victims. They're talking about creating a WhatsApp group for the ORAD event, which is pretty cool. I don't even have WhatsApp, but I think it's pretty cool that people are getting excited for that. So folks, have fun. Remember, you can still buy virtual tickets. $99 will give you the replay of the event. I think we sold 25 tickets. I honestly thought we'd sell 50 or more, but it is what it is. So if you want to watch the event virtually, you can see the agenda on Eventbrite. And yeah, I think we're 8 days away, 8 or 9 days away from Vegas event. And I can't wait. All right, folks, take care of yourself. Have an amazing day. Later.